It looks like synthetic shares are confirmed to be running wild with stocks such as GME and AMC. Let's get straight into what Dave Lawyer has to say. As you guys know, he has been on CNBC. He has been on many other ape finance channels to go over synthetic shares. He used to work at Citadel and actually talked about how their processes go as far as how they operate trading, right? So let's get into all of this information. So Dave Lawyer just put these tweets out about 2 hours ago and says, sounds like the GME stock split / dividend has completely destroyed some brokers' back office systems. I keep hearing about the nightmare of dealing with TDA. Also sounds like overseas brokers are having serious problems and German brokers are struggling getting shares to people. And there's more. There's a bunch more tweets. We're going to read them all because they're all quite intuitive, educational, and at the very least, acknowledging a problem. So it says, my opinion is that at this point, it's a bit late in the game. If you still haven't received your shares, it's time to get concerned. For US brokers, you should push hard to get to someone senior who can help. Overseas, it's less clear to me what your options are. People keep asking me whether this is the first split as dividend and why brokers are having such problems. It's not the first, but it's also not normal. Very much an edge case. And payment for order flow brokers usually don't invest in any tech that doesn't result in their customers trading more. I think generally with GME, we've seen a lot of back office problems such as spikes in FTDs. It's possible that distributing the split as a dividend has exposed a lot more problems in how brokers are booking and holding shares for their customers. FINRA should investigate. Even when shares are recovered, some people report that the broker treated them as trades, not as a split. If broker investments is back office system cause tax implications for their clients, that's a huge problem. You'll want to make sure tax forms are correct next year. So basically what he's saying is kind of what I've been talking about for a while now. Now let me explain. I've been essentially saying that if you are just buying stock in AMC and GameStop and really any other stock, there's nothing physical there. You have never once seen a real share. You don't get paper certificates anymore. It's all computerized, right? Pretty straightforward. You've never seen a share. You don't know that it actually exists besides a number in your portfolio. So what is the real obligation? What is holding firms back from just letting you buy more stock, just putting a fake number out there that is not real? Well, essentially nothing, right? Brokers and specifically market makers are allowed to do this, and that's how you can get some FTDs if there just simply isn't enough shares available. But in theory, they're supposed to buy back those shares and give you something that is actually tangible. And your Robinhood, your Weebles, your TD Ameritrades, your E-Trades, whatever brokerage you're using, should in theory have those shares on their balance sheet or in your portfolio. Now, what's been happening this whole time and why so many people complain about we've been buying the dip, we keep buying, and there has been more net inflows to these stocks by a very high margin over the last year and a half, and the stock hasn't been going up. AMC, GameStop, I mean, you've trended to the downside. Even though people acquire more and more shares, it does not reduce the float any less. There's still a bunch of shares outstanding, right? When in theory, there should not be. It's because these brokerages, they're letting you buy these shares. It only becomes a problem when you go to sell, right? So imagine it like this. If AMC, let's call it 513 million shares outstanding. That's the last number of legal shares we knew about. Well, I think it's pretty clear to say that in all of our portfolios, we own more shares than is outstanding. Like, that's almost a fact at this point. We're going to use AMC as an example. So what's to say the brokerages, if there's no more shares available, they're not going to not make money off of you. They're going to make money off of you. So they're going to let you buy those shares. They're going to give you this fake number. They're going to give you these fake shares. And what's the real problem? It's when you go to sell. When you go to sell, somebody else needs to get paid out. It's not just the brokers taking your money and giving you a fake number on the screen. No, there's another counterparty there besides just you and your brokerage. So that's the problem, is when people actually go to sell, or in this case with GameStop, when essentially the company gave out these shares, and there's so many different obligations to get these free shares, and there's not enough shares available. So what's the silver lining to this? What's the good and the bad? Well, the good and the bad is kind of what we've already been facing, right? The bad, there's a lot of dilution. There's a synthetic dilution, not because the companies are just diluting the stock, but because brokerages just issue more and more shares. The positive thing about all this is we are exposing a big problem. And when people continue to buy, especially when you get dividends, that's the real kicker. When you get share dividends, like you did in the case of GME, or when AMC likely to issue a dividend sometime around August 4th, around earnings. That's kind of what Adam Aaron alluded to. Well, the other counterparty there is responsible. So you have the obligation and essentially the commitment from the broker to get your shares or get your cash equivalent. Because in theory, if you own a lot of synthetics, what do the brokerages have to do? Well, they just have to give you your money. Doesn't matter, right? If you bought 10 synthetic shares for $30 a piece, you spent $300. Now the stock's at $500 a piece. Well, you could still sell 10 shares for $5,000. You're going to make a massive profit. If those shares are just non-existent, well, someone else is going to have to pay for that. The brokerage, the market maker, who else knows, right? So that's really the good and the bad here. It's kind of what we've been facing this whole time, but Dave Lawyer is going on to expose a very big problem. And overseas, it's a big problem as well, because market makers, they act as global market makers, and arbitrage is a term I'm sure you guys are familiar with, but the actual definition of arbitrage is taking, say, GameStop or AMC shares in America, selling them or buying them overseas, where potentially there's even less regulation on these kind of things, to keep both markets liquid, to keep price discovery really in line. So it's actually encouraged to do arbitrage trading with market makers, but you get a lot of these problems. And I believe right now, from the data that we're getting, from what Dave Lawyer is saying, from everything else that we have seen and went through over the past year and a half, there's a lot of obligations, or people that are owed shares out there. So when people actually go to sell, that's when you could see some real problems for market makers, for hedge funds, for brokerages. And just know, in the end, you will get paid as long as you have your FDIC insurance and your portfolio is $250,000 or less. So there is that. Big problems going on with GameStop and AMC. Ultimately, these things tend to be bullish things. FTDs, right? They have to be bought back. Remember this. If none of that made sense, there's always another party involved, especially when there's a dividend. When there's a dividend or new shares being issued in the form of a dividend, somebody else has to pay that, and somebody else will have to find shares. That supply and demand imbalance should mean that the prices of GameStop and stocks like AMC should make a move to the upside. So there is all of that information. Now let's talk about AMC stock for the day. And the markets have really started to take a turn for the worst. As you guys can see right here, the S&P 500 is down about 0.60% at the time of recording this video, not quite to the end of the day. So we're either going to get one of those wild sell-offs into close that we used to experience a lot more in earlier 2022, or potentially we could rally to new daily highs by the end of the day. Who knows? Nothing really sparked this sell-off that I can see. There was no specific data that came out. You're just seeing stocks like Apple, stocks like Microsoft, Amazon's, Tesla's starting to roll over and give back some of those gains that we have seen. And specifically on Apple, this one is a real kicker. So you could see this trend line that we had drawn since what was this, about August of 2020. It was a picture perfect, just clear trend line. This was actually, I believe, the 200-day moving average for a while. Obviously, it's adjusted since the price of the stock has come down a little bit, but you're now finding resistance at this trend line, right? So it looks a little bit toppy. It looks like this rally in Apple, which controls 7% of the S&P, is really starting to top out a little bit, and you could see some more downside. Now, the beautiful thing about AMC as of right now is that AMC has really been doing its own thing. AMC is not really caring all too much, you know, what's going on with the markets. Well, AMC was up about 4.5%. Now it's only up about 2.5%. We're fighting around that $15 level. So today, by the end of the day, if we can close above 15, that should turn into a support level over the next couple of days heading into earnings. If we are under $15, then that's just going to be another resistance level. As long as we stay above the 50-day moving average, which is at $13.63 per share, this is very, very good. What you really want to watch for, if you boil all the technical mumbo jumbo down, you want to have up your 50 and 100-day moving averages. And you want to watch to see how does the stock move around these moving averages. Do we hold up above 15, break out above the 100-day moving average? That will turn into another level of support. If we break it down to the 50-day, watch to see if that becomes support. If you break under that, well, things could get a little dicey in AMC stock. But we are above the 50-day moving average. We're almost above the 200-day moving average, which has not happened since March of 2022, and before that you have to go back to November of 2021 to see AMC stock above the 100-day moving average. So the 50 and 100-day moving averages are longer term trends, so when you can break out above those moving averages, well, that is showing you a good and healthy trend, and that is either what we could see by the end of the day today, or we could see before earnings that come on Thursday. Now, if you guys are unaware of the earnings we have for the day, and even, you know, until Thursday, you have Pinterest and after hours, Devon Energy, Activision Blizzard, Avis Budget Group, tomorrow pre-market, Uber, Caterpillar, BP, JetBlue, Marathon, Marriott International, and Ferrari. Tuesday after hours, AMD, PayPal, Oxy, SoFi, Airbnb, and Starbucks. Tuesday and Thursday are going to be the biggest days, and then on Wednesday, pre-market, Under Armour, Moderna, CVS Health, Regeneron, Yum Brands. Wednesday after hours, you have Lucid and Robinhood. Thursday pre-market, Alibaba, Kellogg's, Crocs, Datadog, ConocoPhillips, Eli Lilly, and Penn National Gaming. Thursday after hours, AMC, Square, Block, whatever you want to call it, Warner Brothers Discovery, Fubo, Twilio, Carvana, and Cloudflare. And on Friday, you do have DraftKings. So we do have a very interesting lineup of earnings, and I think those will be important, and they will move the markets. The biggest thing, if you guys did not watch the video earlier, I do highly recommend you guys watch the videos in the early afternoon. You watch the video that comes out at 4 so you can stay up to date with the broad macro market news or events that are happening that will play a role into AMC stock and how that stock moves. But for tomorrow, you have 10 a.m. JOLTS job openings for June, expecting 11.25 million job openings. The lower this number comes in as, the more bullish the markets are probably going to be, because the Fed won't have as much room to keep raising rates. But the most important thing tomorrow is definitely going to be Fed Evans. If Fed Evans gives us a kind of glimpse into what could happen at the September meeting, well, that's going to be new information, and the markets will have to rapidly start to price that in with a greater probability of happening. For an example, if Fed Evans comes out and he says, yeah, we're at the neutral rate, we can really slow down and start doing normal rate hikes, 25 basis points, the markets are going to go absolutely freaking crazy tomorrow, right? That's just a fact. We're expecting a 50 basis point rate hike right now. If we get expectations of a 25, well, that's going to be very good. On the other hand, if Fed Evans says, yeah, inflation is way too high, we're going to have to double down and keep going super aggressive, markets are not expecting that after the last Fed meeting. The markets have been off to the races because they expect a Fed U-turn. That's why Fed Evans will be so important coming tomorrow. So there is that. Something else you guys probably want to know, and I did call this out in the last video, so I apologize if this part of the video is a little bit redundant, but Pelosi is going to visit Taiwan, local media says, despite China warnings, and expected to visit there on Tuesday. So I believe that would be like overnight tonight. Futures markets might be affected by whatever happens, but essentially China said they'll There's been some reports that they're going to shoot down Pelosi's plane. They're going to do all kinds of things between like just aggressive statements, right? A lot of talk out of China, or World War III. There's like a whole wide spectrum of things that you have heard that China is going to do because China thinks Taiwan is theirs. Doesn't matter to me. I'm out of the politics. But as far as the stock market, anything that is aggressive towards America or is aggressive towards business regime in China regarding American companies like Apple, Tesla, so on and so forth, will obviously be very important, and that might be what is causing a slight sell-off in the markets that we are seeing here today, down about 0.5%. This could be a technical sell-off as well. We've ran really hard, really fast, and we're just due for a pullback, especially in the stocks that have the largest weighting of the S&P, something like in Apple. So there is all of that. As far as AMC and the Ortex data, we are getting 3 orders totaling about $116,000, positive order value of 100%, and you are seeing an August 5th $15 call, a August 19th $15 call, and an October 21st $17 call. All of those are bullish options. Now, as far as the cost to borrow max, that's sitting at 13.33%, cost to borrow average at 10.11%, and cost to borrow minimum at 8.6%. So looking good right there. Cost to borrow up about 3% on the day. The dollar amount of short interest is sitting at about $1.46 billion. Estimated short interest of free float at 19.47%. Free float out on loan 27.72%. Shares out on loan about 143 million. Days to cover 3.43. Cost to borrow 9.82% and 100% share utilization. So there is all that information. Again, yield curve is still inverted 29 basis points. That means investors again are selling the 2-year bonds, they're buying the 10-year bonds. It acts as a dividend stock, so go over that a couple times in your head. When a dividend stock falls, the yield goes up. When people buy a dividend stock and the stock goes up, well, the yield goes down. Same thing with the bond market, and that's what's happening. That's why you're getting the yield curve inversion. It's a signal that inflation is either going to stay over 3% over the next 2 years, or the Fed is going to break something and push us into a recession. Yield curve inversions have always forecasted recessions, even when the yield curve inverted in July or August of 2019. You had the COVID recession about 3-4 months after that. So even weird inversions like that, you know, can definitely forecast and do forecast a recession to come in one form or the other. So that is going to be all for this video. That's what you guys need to know. Here it is. Laid it all out for you guys. Hit the like button, subscribe to the channel if you guys have not already. Thank you for tuning in. If you want to come trade with me live in real time, link down below in the description, and get your free stocks. Also, link down below in the description. You guys enjoy the rest of your day, and I will see you in the next one.